Certainly news is one of the main drivers of the market, and it perpetuates a trend and direction. However, we have no ways of predicting the news in the first place, so we might as well just run with the news and treat it like a variable which we have no control over. But we trade the markets in the way which gives us complete peace of mind no matter what the news is. Of course, we have no way of predicting the news, and our high reward risk profile will always carry us no matter whether we're right or wrong, and whether the news is in favour of our trade or against our trade. So as we trade the daily, like we've just mentioned, the harder time frame, the more immune it is to news announcements. And that will typically be because we have a higher distance or number of pips between our entry and our stop loss. So we've got a lot more collateral and security, rather than just having a small distance between our entry and our stop loss, like what a lot of intraday traders have, where news can typically be spiked out. Maybe it's a spread that spikes them out of a news decision when news is announced, only to find that, ironically, the trade actually does go their way. Fortunately for us end-of-day traders, we don't really have that problem, unless it is an end-of-the-world event. And also, we are technical traders. Don't forget that for a second. We are simply trading probabilities on a chart according to patterns in price action. And essentially, we trade what we see, not what we think. If we are trading what we think, i.e. on the fundamentals, on the newspaper reports, Reuters, CNN, Bloomberg, then there's a whole new level of ambiguity that manifests itself. And as we do not trade fundamentals and we trade the technicals instead, we have no interest in what the newspapers are saying, the journalists, the radio stations. We just want to keep our lives simple and straightforward. And sure enough, there's absolutely no way at all of predicting news, unless you have the inside circle access to government, agencies, central banks and lawmakers, which, face it, none of us have. And it has often been alleged that trying to guess the outcome of a news announcement is a mug's game. Certainly, you'll hear of instances where various funds and banks get it right some of the time, but you might not be surprised to discover that nobody gets it right the whole time. And our job as technical analysts is just to simply look at a chart and weigh up the probabilities and see if the reward to risk stacks up in our favour empirically. Also, as trading is a business for us, we want to keep our overheads low as possible, like any business owner would want to do. So spending extra money on extra screens, data feeds, trying to crunch the numbers ourselves is wholly unnecessary, especially when you hear of investment banks spending hundreds of thousands on whole teams dedicated to crunching the numbers and predicting the news outcome. But the great news for us end of day lazy traders is that our high rewards targeted on every trade we take will always carry us. So if we're right with the news announcement, and given that there's a 50-50 chance of the news going in our favour, and it does go in our favour, then it helps to perpetuate a winning trade, hit our 3% target, 3% being our minimum threshold, risking only 1%, whereas if news is against us and we happen to be wrong, then we've only lost 1%. So it's similar to flipping a coin really, and choosing heads or tails. Statistically, there is a 50-50 chance of it landing on heads as it is on tails, but imagine if somebody told you that if you were to get it right and it landed on, say, heads, you would get £300, but if you're wrong and it happened to land on tails, you lost £100. Given the 50-50 outcome of this, and the fact that you get a lot more money if you are right than the money you'd lose if you're wrong, you will keep on flipping that coin. And this is exactly the same concept as high reward to risk trading as far as news is concerned. So please don't get stuck into the trap of thinking that you need to have access to all sorts of sophisticated data terminals and chat rooms and spending more money on monitors. We just want to keep life simple as possible, keep the high reward to risk in play, and just go for the high quality trades. And this is something which we'll be teaching you to do a little bit later on in your course. I just want to show you a quick example here. This is pound CAD on the weekly, and this cross-currency pair, as you can see for yourself, has been moving sideways for over 2 years. And as soon as it gets to the 16400 level, round about here, it rejects it and comes back down into the range. And the lowest it's been 15302, and as soon as it gets to this level, it bounces straight back up again and goes to the top of the range. Statistically, you can see that there's a very high likelihood that if and when price action comes up to this level again, it's going to bounce down. So, say for example, you're on the daily time frame and price action has come up to this level, and the next day it's something like non-farm payroll day, for example. Just a news announcement picked at random here. So you can see that there's a very high probability you can get a decent reward to risk trade out of this one here, given that it hasn't breached this level in over 2 years. So you could be forgiven for saying to yourself and arming yourself with this logic that, okay, if I have my entry to go short on this level here, and I have my stop, say 50 pips away, above the level, you can say, well, okay, I'm going to risk 1% and have a difference between my entry and stop loss of 50 pips, and target 3/4 of the way down the range, and target 823 pips, knowing full well that thanks to the high reward to risk nature of it, and the fact that 823 pips, which is the amount you'll be targeting divided by how much you've risked, 50 pips, gives you a reward to risk of 16.5 to 1, you could simply say to yourself, well, if non-farm payroll, if the figures the next day are positive, then it will help you perpetuate your winning trade to a 16.5 to 1 reward to risk, i.e. if you had a £10,000 account, you could potentially gain £1,650 from it, versus if you risked just 1%, and if you're proven wrong and the news goes against you, then you've lost just £100. So remember back to the coin flipping example. If, for example, news is in your favour and it does come to this level, triggers you into the trade, and this level holds and it goes down to hit target, and the coin lands on heads, you're right, you made £1,650, and it hits your 16.5 to 1 reward to risk target, then it's a risk worth taking. Whereas if you're wrong and it breaks the level and you've only risked 1% of your account, then at least you could say that you've kept yourself in the opportunity flow, and sod's law, had you not even tried, it would have gone your favour anyway. And being in the opportunity flow is absolutely crucial to trading, especially if you get a setup as strong as this. So hopefully we've helped establish that news doesn't really matter too much. Just let trading become a peaceful hobby without having to worry about what the news is happening, because, as I just mentioned, it can either help a winning trade with great reward, or it can help get you out of a losing trade far quicker so you can go on to the next trade with high reward.